All right.
Jerry, do you want to, before we start, do you want to just mention the dates for Notre Dame and whether we're hopefully going to be there live this year?
Well, we might not be. This year's Notre Dame Tax and Estate Planning Institute is scheduled November 10th and 11th in South Bend, Indiana. And we hope to have it live, but we'll see what happens. I've lined up all the speakers and the topics. This is an example of one of the practical topics that will be available at Notre Dame, which really has nothing to do with saving the estate tax. It's more what has a business purpose. But in any event, over the next several weeks, sometime in June, we might decide to flip it back to virtual again, because we don't want to take the risk of a new variant coming out and have to cancel and switch to virtual at the last minute. But either way, we're going to have the program. All right, so now this is a situation which comes up a lot of times. An individual has a closely held business and none of the children work in the business. And the individual cannot afford to give the business away because they're not extremely wealthy. And so we have a situation where senior has a very successful dental practice, intends to retire sometime in the future, gradually, and also senior wants to pass the business on to the junior dentist, and none of the children are dentists. And they've agreed that the dental practice is worth $1.5 million. And because it's a self-generated asset, senior's income tax basis or cost in the business is zero. And the idea is senior will turn the business over to the junior dentist, but really cannot give the junior dentist the business because senior needs the income in one way or another from the business. And more importantly, senior says, I'm going to continue practicing after I turn over the business to junior, but I'm not going to practice full time. I'm just going to continue partially and eventually, separate from the business entirely. So most people would think, well, the business is worth $1.5 million. So the easiest thing to do would be for, where's the advancement here? I'm looking for it. It disappeared. I can't find it again. Kelsey. Oh, there it is. I got it. So the key to today's presentation is we need to have a planning technique that can accomplish the business, financial objectives, and the tax objectives for what senior intends to do to pass the business on to the key employee who will take over the business. Okay. Now, the problem is that the income, there can be some income tax problems. For example, if senior sells the business to junior for $1.5 million, senior is going to have to pay income taxes on that gain. It'll be a capital gain. And instead of having $1.5 million, senior will end up with the after-tax amount to generate income. So what we're going to try to do is show you how can senior have a rate of return from the entire $1.5 million value of the business and for the rest of senior's life or the life of senior and senior's spouse, and never have to report the $1.5 million of gain. So the simple situation is, suppose junior buys the business outright from senior immediately for $1.5 million in cash, and he has $1.5 million gain and the state and federal income taxes on that gain are $375,000. Therefore, senior would net $1,125,000 after taxes. So senior would say, that is what I need for retirement, and I'm going to invest $1.25 million at about a 5% rate of return because I can't afford in my retirement to take too many risks. And so I can have a $56,000 annual income on the after-tax proceeds. And what we're going to show you is how can we accomplish all of the objectives, senior not having to report the gain, and senior having for the rest of senior and senior spouses' lives a 5% rate of return, not on the $1,125,000 after-tax proceeds, but on the entire pre-sale value of $1,500,000. Now, right away, we have a little problem here. If senior says, I just want the cash, where is junior going to find the cash to fund the buyout? The key employees that you want to transfer or pass on the operating business do not have the cash resources to come up with the entire $1.5 million up front. So basically, we can say, well, there is a nice solution here. Senior can sell the business to junior for what is called an installment sale. Okay. In other words, instead of junior having to come up with $1.5 million of cash immediately, senior can sell the business and take back junior's promissory note for the entire purchase price. Now, if senior sells the business and junior gives senior a $1.5 million promissory note, that promissory note can pay 5% annual income. And what this means is that senior can have a rate of return on the pre-sale value rather than the after-tax value. Now, eventually in this situation, this is what's called an installment sale. And the nice thing about an installment sale is very simple. First of all, senior received a $1.5 million promissory note for a business with a zero cost. So immediately, senior realized a $1.5 million long-term capital gain. However, under the income tax rules, they're called the installment sale rules, and it's right there in the statute. It's called the installment method. Senior doesn't have to report any of that $1.5 million gain realized on the initial sale until the principal payments on the note are paid. So what this does is give junior the ability to come up with the cash to pay the principal on the promissory note at a more financially advantageous situation. Now, interestingly enough, junior is going to still have to pay the interest on the promissory note, but the money that senior was initially taking out as senior's own salary stays in the business, and when junior purchased the business, the money that would otherwise have been paid to senior as a salary, junior can use to pay not only the interest on the promissory note, but amortize the principal. There is one little problem with this. Senior will have a $1.5 million promissory note with a zero income tax basis because senior did not report the gain. And if senior dies with that promissory note, there's a special rule that says senior cannot take a step up in basis at death because that was gain that was already realized. And there's a special rule called income in respect of a decedent that says when senior dies, his estate takes the same basis in the promissory note that senior had. So one of the disadvantages to an installment sale is that $1.5 million of gain, even after senior dies. What happened, Alan? Alan, what happened? I lost everything. Okay. I touched something. I'm saying. Where's mine? Okay, I'm back. All right. Okay. All right. So let's go on. All right. All right. So the problem is Junior will have to come up with the $1.5 million at some point in the future. Okay. Now Junior can borrow the money from a bank, but that creates financial problems because the bank will require that the principal and interest on the bank loan be paid regardless of what income Junior is earning from the dental practice. So borrowing from a bank to fund Junior's buyout financially is not the best idea. So now, okay, there are a certain number of other business concerns. After Senior transfers ownership of the business on to Junior, Senior is going to continue to be compensated for the hours that Senior works, and eventually Senior is going to wind down the hours and eventually not do anything. But this has to be taken into consideration. This is not a tax concern. This is a business concern, okay? But here's something very important. The business has been very viable because both Senior and Junior have been generating the income from the business. When Senior eventually winds down and permanently withdraws from the business, Junior is going to have to figure out how to replace Senior as Senior gradually retires. And this is a cost, a business concern that needs to be addressed up front. So now let's look at what I have as a solution, okay? First of all, Junior does not have any immediate cash to pay Senior and really doesn't want the pressure of having a bank loan, which means you got to pay the principal and interest on the bank loan, even though the business may not have a good year and generate sufficient cash. So what we do here is use what's called a preferred partnership. Now, this structure can be used in regardless of how the dental practice or the business is owned. In my example, Senior owned the dental practice outright. However, Senior could also own the dental practice in the form of a wholly owned S corporation, or it already can be a partnership. So what we're going to do is this structure works regardless of how the business is owned. So what happens is we know that Senior's value of the business is $1.5 million. So let's assume that Senior's dental practice is owned by an S corporation, that Senior owns 100% of the stock. So what happens is Senior S corporation will form a partnership, and the S corporation will contribute the value of the business to the partnership for what we call a capital account, which is the $1.5 million value of the business. Now, we want Senior's S corporation to be able to get income from the practice. So the preferred partnership interest that the S corporation receives is going to get what is called a priority allocation of profits. And by the way, Junior will become a partner in the partnership without having to make any capital contribution. So Junior's initial capital account, or the equity that Junior contributed to the partnership, is zero. Interestingly enough, there are some very draconian rules in the Internal Revenue Code under section 2701 that require certain requirements if you have a preferred partnership and the common partner is a related party. But guess what? Junior is not a family member, and therefore all these special rules for preferred partnerships in the Internal Revenue Code do not apply. So how does this preferred partnership work? Well, we're going to give senior a 6% priority allocation. Now, what does a 6% priority allocation mean? Very simply, I take this preferred interest is the practical equivalent of a bond. It's like I just bought a bond for $1.5 million that pays interest every year at 6% or $90,000 a year. Well, the preferred interest is very similar, but it's a little bit different because with the preferred interest, you don't ever have to amortize principal, whereas with a bond, eventually it has to be paid off. All right. So in this situation, 6% of $1.5 million is $90,000. What this means is that the first $90,000 of the preferred common partnership is allocated to the preferred, and only income in excess of the $90,000 is allocated to the common. Now, the point is, what if the partnership doesn't have up to $90,000 of income? That means Junior will get nothing. Well, Junior was getting a salary already from the dental practice. So what we do is in the partnership agreement, we give Junior what's called a guaranteed payment, which is the practical equivalent of a salary. And because this is a guaranteed payment that's paid regardless of the income generated by the partnership, it is really a compensatory payment. So the partnership gets a deduction for the guaranteed payment, and Junior reports the guaranteed payment as taxable income. So in this situation, okay, now here is what does the $90,000 represent? Well, remember, Senior was already receiving a salary as the owner of the business. So essentially, the guaranteed payment is the practical equivalent of the salary that Senior was already taking out. So what this means for all practical purposes is it doesn't really require to generate excess cash, because the reduction in the salary that Seniors was receiving is the practical equivalent of increasing partnership profits. Now, so basically, and by the way, in this situation, remember, Senior was thinking of investing the after-tax proceeds at 5%. Well, I just used 6% because the priority return that you're going to give to the preferred interest is a business decision. And in that situation, I said, we can make this even more attractive to Senior because we can give Senior 6% on $1.5 million. And remember that the $90,000 really is a substitute for the salary that Senior was taking out of the business. But Senior is no longer working in the business, so what Senior would have taken out as salary is now available as profits. Now, what's interesting in this situation is Junior now doesn't have to come up with any cash to pay Senior the $1.5 million. However, eventually Junior would like to eliminate Senior's preferred interest, and the preferred interest gives Junior the flexibility to gradually distribute excess cash from the business to be applied towards the $1.5 million that Senior made as a capital contribution. Okay, so in this situation, okay, the financial advantage is junior can buy out senior's preferred interest only as the cash flow needs of the business increase to or are available to redeem senior's preferred partnership interest. The only problem senior will face is if senior's preferred interest is redeemed while senior is alive and senior has a zero basis in that 1.5 million preferred interest. So let's suppose in year 4 or 5, junior has 200,000 of excess cash and uses that to redeem senior's $1.5 million preferred account, reducing it to 1,300,000. So therefore, junior would have to report in that situation a $200,000 capital gain. Now, so basically, this is what's interesting. Senior now has a preferred interest in the partnership, and that preferred interest is not a readily marketable. So right away, even though it entitles senior to a distribution of, or entitles senior to an ownership stake in the business worth $1.5 million, it is not liquid. So it has lack of marketability, and also senior no longer has absolute control over the business. So essentially in this situation, senior could discount the preferred partnership interest, say from 1,500,000 and value it in the gross estate, say at $1,200,000. Well, guess what? No gain was realized when senior converted his ownership stake into a preferred interest. There was no sale. So unlike an installment sale where gain is realized, but deferred under the installment method until principal payments on the note are paid, this isn't a sale. This is just converting senior's ownership interest from a regular interest into a preferred interest, and therefore it's entitled to a step up in basis at death. So if they basically senior dies with this preferred interest valued in the gross estate, we can reduce senior's gross estate by the amount of the discount, and his successor in interest to the preferred interest would take an income tax basis in the preferred interest of $1,200,000. However, remember something: if senior is not a multimillionaire and is not going to be exposed to estate tax, remember, after 2025, the amount that will be exempt from estate tax will be $6 million per person, which means 12 million of net worth will not be exposed to estate tax. So no estate tax return is filed, and we don't even have to take discounts and just value it at $1.5 million. Now here's something interesting. Senior says, this is not a very bad investment. I have this nice preferred interest that's generating a 6% rate of return, or $90,000 annually. And where am I going to get that kind of nice conservative rate of return from a business that junior is running, and I trust junior to continue running the business? Okay, so what if senior takes this preferred interest and puts it into a trust for the benefit of trust beneficiaries? Now, $90,000 of income will be taxable each year, but if we kept the $90,000 in this trust, and the trust did not distribute the $90,000, it reaches the very top marginal income tax bracket at $13,000 of taxable income. So why should we keep $90,000 that will be taxable at the highest marginal income tax rates of 37 or of 40% or whatever it is that trusts are subject to. But interestingly, if the trust distributes any of its income to its beneficiaries, in that situation, the income is conduited out to the beneficiaries. In other words, the trust reports $90,000 of income, and if the trust distributes, say, $80,000 to the trust beneficiaries, the trust gets an $80,000 deduction, so its income is only $10,000, and the beneficiaries have to report the $80,000 of income. Well, interestingly, remember, senior is, when senior passes away, senior is going to have children and grandchildren and maybe even great-grandchildren. And these all can be beneficiaries of the trust. So the trust can distribute its income to any one of its beneficiaries who are in lower income tax brackets. And even if the beneficiaries are minor grandchildren, senior can have the trust distribute each year $2,300 of this passive income to each of the grandchildren. And there's something called the kiddie tax, which doesn't really apply to the first $2,300 of passive income that a minor child receives. So essentially, if senior has 6 grandchildren, each year the trust can distribute $2,300 of income, almost $19,000 of total, to each of the 6 grandchildren, who will be taxable on the $2,300 at 5%, rather than the trust at 40%, or seniors' children who are now all very successful and are in the highest income tax bracket. Now, the nice thing about this is a disposition of the preferred interest. There is no gain realized because it's still, and you get a step up in basis. But if I wanted to dispose of my preferred interest into a trust as a gift and trust while I'm alive, there's no income to report. So I can basically also give that promissory note to my trust while I'm alive. The only problem is if I give the promissory note to the trust while I'm alive, it's not included in my estate, and I don't get a step up in basis at death. Interestingly enough, if senior sold the business to junior for junior's installment note, and senior wanted to gift that promissory note to a trust for the children, there's a special rule in the installment sale rules that says if you dispose of your installment note where the realized gain is being postponed and you dispose of it by gift, all of the gain previously deferred under the installment method is immediately accelerated. So the preferred interest has a lot more planning flexibility than a promissory note under the installment sale. Okay. Now, so here's the question is, do we want to give junior the ability to decide if and when the preferred interest is to be redeemed? Okay. Now, senior might say, wait a minute. Junior could say, I want to redeem my preferred interest while I'm alive. I don't get a step up in basis at death. And remember, the idea behind this is going to be a preferred interest to provide $90,000 a year to senior and senior's spouse for the rest of their lives. So they want to take advantage of having this $90,000 of retirement income for the rest of their joint lives, and also include it in the gross estate to get an income tax-free basis step up at death to like $1.5 million. So if it's eventually redeemed for $1.5 million, there'll be no gain. So essentially, one of the business concerns in this partnership agreement is basically say that junior cannot redeem any of the preferred interest while senior and senior spouse are alive unless they give permission to junior. So that is not a bad idea. Now, the other thing is maybe the children say, once mom and dad are gone, I want the cash. So you could put into the partnership agreement that when mom and dad pass away, junior is required to redeem the preferred interest for $1.5 million. Junior will not have all $1.5 million, but you can require junior to redeem the interest gradually over, say, a 5 or 6 year period. Okay. In addition, you want to give the flexibility after senior and senior spouse die, give the children the flexibility to say, we want to continue receiving the preferred return, or we want to require junior to redeem the preferred interest. Okay. So these are all business decisions that play a role in deciding how we draft this agreement. Okay. Now, so that very simply is the preferred partnership interest. And it is a very practical approach because what it means is senior does not have to report any gain. Senior is getting a guaranteed rate of return. And more importantly, senior is getting the rate of return on the $1,500,000 value of the business instead of the $1,200,000 after tax proceeds from the value of the business. So this becomes very attractive. Now, there are some alternatives, and one of them is called an employer stock ownership plan or an ESOP. And my recommendation is for small, closely held businesses that aren't really under over $10 million, we do not recommend ESOPs, okay? Because what is an ESOP? Well, it's very simple. The senior sets up an ESOP, and we have what's called a ESOP trust. And the key here is, number one, the ESOP trust has to borrow $1.5 million from a bank, and then they give senior the $1.5 million of cash. Senior invests the $1.5 million of cash in marketable securities and doesn't report any gain. And because senior doesn't report any gain and had a zero basis in the business, senior's basis in the marketable securities are also zero. So the problem here is, remember that an ESOP is nothing more than a qualified deferred compensation plan for the employees. And where is the ESOP trust going to get the money to pay senior $1.5 million? The ESOP trust borrows the money from a bank, which means the ESOP trust now owns the operating business and has to pay back the bank $1.5 million, regardless of how the business is performing. So it puts financial pressure on the business. Secondly, this is not something that the employees can access immediately. It's a qualified retirement plan. So essentially what that means is the employees have a qualified retirement plan and they can't really start to take anything out until they reach age 59 if they want to take it out before retirement. So in this situation, you have the same financial pressures that you have, and the employees can't really access any of the excess earnings in the ESOP trust while they're still working. So They don't have the ability to take the excess profits out immediately until they get to be age 59 and a half. Interestingly enough, this is nothing, the employees will end up having to report any distributions from the retirement plan as taxable income. But here is the real problem. Because this is an employee retirement plan, you must cover a broad cross-section of employees, and you can't limit it to only key employees. So if you have an operating business where you have 3 or 4 people who are really your successors to run the business, and they have a group of like 20 or 30 employees, the ESOP will require you to include in the key employees retirement plan all of the non-key employees. So ESOPs look attractive, but it is financially not an appropriate situation for small businesses under $10 million. Now, so everybody says, oh, the solution is simple. Fund the buyout agreement with life insurance. Because life insurance proceeds are income tax free. So all you have to do is have the business buy a life insurance policy with a $1.5 million death benefit on senior's death. So that means that when senior dies, he gets a step up in basis at death for his $1.5 million interest in the business that senior still owns. And senior's estate gets a step up in basis, the business gets the life insurance proceeds, and therefore senior's estate gets $1.5 million and with no gain to be reported. There are several problems with this. If senior retires and doesn't work in the business after senior retires at age 70 or 75, and he just has an interest in the business that gets in the buyout, the problem is that senior is going to have to report the income in the business that he retains from his share. But basically senior says, you know, I want to retire. I really like this preferred interest, but the life insurance only pays when I die. Well, so what we can do in this situation is very simple, okay? Senior contributes his interest in the business to a partnership, or the S corporation contributes its interest in the operating business to a partnership for a preferred interest, $1.5 million preferred interest with a $90,000 profit allocation, okay? And so that means every year while senior is living, senior and senior spouse can receive $90,000. When senior dies and the trust collects the $1.5 million, senior gets a step up in basis for the preferred interest to $1.5 million. The business collects the $1.5 million death benefit and uses that to redeem senior's preferred interest. Okay. The only problem here is the cost of the life insurance. It is an expense that is not deductible. And if you're going to insure somebody age 70 or at this late point in time, the cost of the life insurance premiums will be significantly greater than if senior was 50 or 60 years old. But we typically don't do this until senior is elderly and planning on retirement. So in that situation, you're going to have very large annual premiums to pay by the business, which are not deductible for federal income tax purposes. And the older senior is, senior may have health problems, which will give rise to larger premiums. Using life insurance to fund a buyout where senior continues to own the preferred interest is an alternative, but you have to remember there's an expense that is not deductible to fund the buyout with life insurance, and that is you can't take a deduction for the premiums. Okay. With that, I think I finished my slides, and at this point in time, I can take some questions. Alan, do we have any questions here? Hello?
Sorry, Jerry.
Yeah.
Oh yeah, we have a number of questions.
Good. Well, see, I don't have to run over to take the questions.
Well, actually, let's see. No, actually, there were no questions.
All right. Well, with that, thank you for inviting me, and I appreciate the opportunity. And again, this is something very practical, even for individuals who don't have a net worth, so they're not exposed to estate tax. And if they're not exposed to estate tax, don't value the business interest as a discount, because you don't get a step up in basis if you reduce the value by the discount.
Jerry, I have a question. Do you use spreadsheets other than what you've shown in these slides that might be available for people to work from to show how you model this out?
I don't have a spreadsheet for this, but I have spreadsheets for other programs like the Charitable Remainder Trust. But, you know, I don't know if you really need a spreadsheet when you just basically say you sell it for cash, you'll have the after-tax proceeds to invest, you take the preferred interest, you'll get a rate of return on the value of the business, not the lower net cash. You get the step up in basis at death, and it also gives you the ability to do estate planning if you want to dispose of it. But we like to say, keep the preferred interest and get the step up in basis at death, so that the gain will never be reported.
Right. Jerry, are there good white papers, articles, Bloomberg portfolios, or anything else? What do you recommend as far as reading in this area?
Well, interestingly enough, there is no article on it directly on point. And one of the things we're doing by today's presentation is it's being transcribed. And that will be my first draft of the article. And I've committed to publish it in Trust and Estates magazine for their July issue. So it will be forthcoming in July if I get it in by my June 20th deadline. But I have over a whole month to work on the draft and get it up to snuff, and with citations and additional commentary.
So Jerry, you've got a lot of your fans on this webinar, so let me ask you a fan club question. You're doing Notre Dame, you're working on this article. What else are you up to these days?
Well, I'm teaching a summer school course in the Boston University's LLM program remotely. It's called Business Succession Planning, and it's in the LLM program. It's designed for LLM students who have taken all their courses in the LLM program, and they've seen how all the rules, they've seen all these techniques like GRATs, Cuperts, Skins, private annuities, installment sales. And what this course does is take all these techniques and show how they impact and how, and I have spreadsheets that show all the, like you do. Actually, we use Estate View, as a matter of fact.
Nice.
Put in a plug for Estate View. And what it does is the idea, there's two functions. One is to show the students how the various techniques actually work and their financial impact going forward so that they can decide which of these techniques or combination of techniques are best suited for a particular client. More importantly, when I use simple to follow numerical examples and simple to follow spreadsheets, it's to teach the students how to communicate a fairly complex estate planning technique in an understandable manner. And what I tell my students is, if you really think you know how to communicate this stuff well, when you visit your grandmother in Boca Raton, Florida, and you can explain it to her and she understands it, then you know you have developed those communication skills that you absolutely need. Now, the other thing that we do is also show you how to integrate the income tax planning and the financial planning into your estate planning. Because in estate planning, you're so narrowly focused on, saving estate taxes and getting step up in basis at death that they don't consider other situations, like I just mentioned, using non-grantor trust so that you can distribute trust income to beneficiaries who are in lower income tax brackets. For example, what if you have under $80,000 of taxable income and you have a capital gain? What is your federal income tax rate on your capital gain? 0. Capital gains get a progressive rate table. 0% on the first 80,000 of capital gains, and up to 500,000, it's at 10%. So you have a trust that has an appreciated asset that they're going to sell. You can basically assign that capital gain to beneficiaries who are in lower income tax brackets. And
nice.
These are the kind of things that we do in the course. It ties everything together in a way that, and it's a review because they've had all the techniques. But what I do in the course is, like when I go over preferred partnerships, I give a little basic lecture on the fundamental partnership principles. But estate view, which is something that Alan's son-in-law developed, right, is a way to illustrate a lot of this.
So Jerry, let me just show you you can see my screen here, right? Just want to show you some new buttons. Now you can click on Look Up AFR, and it takes you to the IRS page. So that's nice. You can go to Video Tutorial, takes you to the YouTube page where the video tutorial is. So that's nice. And then when you go to the installment sale calculator, which is here now, once you get your installment sale figured out where you want it, you can click to save results to Excel. And now it has created an Excel spreadsheet that you can then adapt.
Well, Alan, all I know is once I have all this wonderful financial projections, I then have to, like, oh my God, sit down and write a letter to the client, basically describing everything in excruciating detail. Is there any way that you could reduce this letter to maybe a click of the button?
I will show it here. So, yeah, all you have to do here is click Generate Client Letter. And there's your letter. Yep, of all the data you put in and all the results.
Not bad. Where'd you get that idea?
Yeah. It was more expensive than a small boat, but less expensive than a large boat. It was a lot of fun putting this together with you. I appreciate all your help for sure.
And what we did is Alan and I took all the materials that we developed for my classes and his presentations, and we basically focused on installment sales to grantor trust. But the most important thing with installment sales to grantor trust is the grantor has to pay all the income taxes on trust income. And there's a point in time when the grantor is going to say, enough is enough. It's depleting my estate too much. So it allows you to basically design your installment sale to show the client exactly what the future impact will be, so you can basically educate the client of when you might want to toggle off grantor trust status and stop what we call the burn.
Right, right. It's been, yeah, it's been a lot of fun for sure. So Jerry, we do have 2 questions now from your presentation.
Okay.
The first one, what about a $100 million business owner is 60 years old and he has 2 children, 25 employees, making 100,000 a year plus? I'm not sure what the question is.
Well, the situation is, with a business like that, you really don't want to pass on the entire business to the key employees, because it's very profitable and it's going to probably appreciate in value. So what you do in this situation is you want to give the key employees an interest in the business, okay? And you also want to pass the operating business as an income producing asset to your children. Now here's the key. The children aren't going to work in the business. The key employees are going to be operating the business. So what we do, now remember, if the business is owned by an S corporation, the S corporation can form the partnership. It's not that, an S corp is not a obstacle. So what I actually have a article on it that I published for the NYU Tax Institute about 3 or 4 years ago that deals exactly with this situation. In other words, we can give the children a preferred interest in the business, and we can give, in other words, we give the children a preferred interest. And then let's say that you have 100 units of common interest. And so what you can do is, and you want the key employees to stay on and generate future profits. So what you do is you give a portion of the common interest, which has no value because they're not family members, so you don't run afoul of Section 2701. You give the key employees a common interest without them having to make a capital contribution. So if you have like 100 common units, you can basically give the key employees, say, 40 common units and give the children 60 common units. And the key is the preferred interest would take out approximately the amount of the current profits after everybody gets paid the salary. So that is a structure that we actually, I think I'm going to add that as a topic of Notre Dame for this fall, because I hadn't thought about that before. Whoever asked that question, thank you. We're going to add that as a topic. We're going to add that to this presentation. This is going to be a topic at Notre Dame that's going to go into much more depth. Because remember, what you're getting here is a kind of the very first run through. So the key here is you bifurcate the business into preferred and common. You give the children all the preferred, and then you split the common between the key employees and the children. So both the children and the key employees can share in the future increased profitability of the business. Not bad. Thank you.
Yeah, and that was from David. Now I got a new one from John. You mentioned that you can assign capital gains from estate, to the beneficiaries to get the benefit of the lower tax rate. Can you please explain how this works?
Okay. Let's show the trust. It's a non-grantor trust. Remember, it has a $1 million appreciated asset with a zero basis. It sells it for a $1 million long-term capital gain. So the trust has to report $1 million of capital gains. If the trust distributes, say, $900,000 of that capital gain, the trust gets a deduction of, wait, I said 1 million, right? Okay. So if the trust distributes $900,000 of its capital gain to its beneficiaries, okay, the beneficiaries report the capital gain. Now, interestingly enough, if the total taxable income of a beneficiary, including the capital gain, is under $80,000, there's no tax on the capital gain. If you're between 80 and 540,000 for a married couple, the tax on the capital gain is 10%. So essentially, if I can just remember, the capital gains rate is a progressive rate. The first 80,000, which is based on your total income. So if I happen to have a bunch of grandchildren who are all in graduate school, and they have very little income, you can distribute like $80,000 of capital gains to them and have it be taxable at 0%.
Wow. Nice. Okay, let me see. There was one more here. Is the ESOP, let me see. When is an ESOP going to be worthwhile in general?
It's worthwhile if the employees understand that this is nothing more than a tax-free qualified retirement and profit sharing plan. Because remember, the ESOP Trust takes the income from the operating business and contributes it to the pension plan and gets a deduction. So if the ESOP Trust, after the bank loan is paid, if the ESOP Trust has operating profits of the business of $100,000, it reports $100,000 in income, puts it into the pension plan, gets a $100,000 deduction. So none of the business profits are taxable. It goes into the qualified retirement plan, and because nothing is paid tax, the employees get the $100,000 plus what it grows to as retirement distributions. So an ESOP, if you want to look at it as a nice way of funding the employee's retirement plan, where the employees, remember, just look at it as a retirement plan substitute, is a very good thing. But remember, the problem is you can't discriminate amongst the lower paid employees, but it's based on their salaries. And if the higher paid employees have salaries greater than the lower paid employees, the cost of funding it for the lower paid employees is not that significant. I don't want to get into ESOPs. I just want to say it's not a great thing for small businesses, because remember, the problem is the ESOP Trust has to pay back the bank loan, and that can put a lot of financial pressure on the business.
But at least the income it receives it doesn't have to pay tax on, so it could pay the bank loan. Basically, tax.
No, the income it receives first is used to pay the bank loan. So that means that it's going to have taxable income, so it has to have enough cash to pay the taxes. It's got to retain some of the income.
Okay. Jerry, well, that was a fantastic presentation, and you ended early. That was interesting. You usually go the whole 60 minutes. So I'm gonna have a couple of law students working beginning a week from Monday. So if you want, they can start, taking that transcript and turn it into article if you want any help.
Well, all I want now is first we got to get it transcribed, and then somebody's going to have to fill in all the nice citations of authority. So
Yeah.
we'll get that done. And this will be a paper at Notre Dame, and we're going to add in $100 million business.
Wow. Okay, well, thanks to everyone who attended this. You helped make a paper at Notre Dame. We should put your name in a footnote.
All
If
right.
you have any other questions, please send them to me or Jerry. If you send them to me, I'll forward them to Jerry. Jerry, thanks for all you do for so many people. My gosh, thousands of tax lawyers. We're all beholden to you for what you've done in the past and what you continue to do. Keep it up.
Well, you know what? My entire practice is actually being a resource for other lawyers. Because they just come. In other words, a lot of times a lawyer is thinking about something and wants to talk it through with somebody. And, I can generally be available. And when they call me up, they say, I'm really not familiar. Will you work with me on it? So.
Yeah, you're amazing. That's why we call you so often.
All right. Take care, Alan. Enjoy the rest of the day.
Take care, everybody. Bye.